Some towns are watching home prices drop 16% in a single year, while banks quietly tighten lending standards. Most people think it's just a few bad markets. If you're the kind of person who wants to understand why financial institutions are pulling back before it becomes mainstream news, subscribe. Because what looks like isolated housing problems is actually banks repositioning for risks most homeowners don't see coming. And that's what we're breaking down today. This isn't about real estate tips. This is about watching an entire system recalculate what a home is actually worth when you stretch the timeline to 30 years. These aren't arbitrary decisions. Banks evaluate risk using data most buyers never see. Flood modeling outside official FEMA zones, insurance withdrawal patterns, mortgage delinquency rates climbing to nearly 6% in some states, and climate projections stretching 3 decades into the future. When lenders restrict mortgages in specific towns, they're not reacting to today's market. They're preparing for tomorrow's losses. Today, we're breaking down 25 U.S. towns and regions where banks are restricting lending. From climate-threatened coastal communities to economically declining Rust Belt cities to overbuilt Sun Belt metros facing 20% corrections. By the end, you'll understand exactly what these lending patterns reveal about where the housing market is headed and why some places are quietly becoming unmortgageable. Across America, banks are recalculating risk. In 2025, mortgage delinquencies hit their highest rates since the pandemic, with Louisiana and Mississippi exceeding 5.7%. Insurance companies are withdrawing from entire states. Federal Reserve analysts predict that within 10 years, mortgages won't be available in some regions due to climate-related disasters. The 30-year mortgage that built American homeownership wasn't designed for what's coming. This channel exists to track those shifts before they become your problem. So let's start with number 25 and work toward the one place banks are most concerned about. Number 25, Greenville, Mississippi. The town where home prices are projected to drop 16.7% this year. A small Mississippi River city facing the steepest housing decline in America. Mississippi has the nation's second highest mortgage delinquency rate at 5.7%. The city struggles with low median income levels, aging housing stock, and limited economic diversification beyond agriculture. When your home loses value faster than you can pay down the mortgage, you understand why banks view this as a canary in the coal mine. Small markets with weak fundamentals collapse first. Lenders are running models where property values in places like Greenville don't recover for a decade. And here's the thing most people miss. When banks see delinquency rates approaching 6%, they don't just raise interest rates. They stop lending altogether. Entire zip codes get quietly removed from lending portfolios. No announcement, no headlines, just applications that never get approved. Would you risk a mortgage in a town losing value this fast? Number 24, Gary, Indiana. The steel city where deindustrialization made mortgages nearly impossible to obtain. Once home to U.S. Steel's largest operations, now synonymous with urban decline, Gary has endured over 50 years of extreme disinvestment. Population declined from 178,000 in 1960 to under 70,000 today. Widespread property abandonment means home values are too low for banks to profit on mortgages. There are appraisal gaps where renovation costs exceed the post-repair value of the home. This is the city where buying a home with cash is easier than getting a $50,000 mortgage. Gary represents what researchers call mortgage deserts, places where lending infrastructure has completely collapsed. Picture entire neighborhoods where traditional mortgages simply don't exist as a financial product. You can find a house, you can't finance it, and once that cycle starts, it becomes self-reinforcing. No mortgages mean no conventional buyers. No conventional buyers mean values stay depressed. Depressed values mean banks never return. What happens to a city when banks stop lending altogether? Number 23. Detroit, Michigan, America's largest city where the housing market has been broken since 2006. A metropolis where most homes still sell for cash, not mortgages. Before 2006, Detroit saw over 3,000 mortgages annually. Between 2009 and 2013, that number dropped to fewer than 375 per year. The median sales price plunged 82% between 2006 and 2008. Current values are still only half of pre-crisis levels. The majority of residents are now renters instead of homeowners. Banks require neighborhoods to achieve $50,000 median prices before lending resumes, and many areas still haven't hit that threshold. There are intervention programs that deliberately lose 15% on every home sale just to restart mortgage activity. Think about that. Losing money on purpose just to prove to banks that lending could work again. Detroit proves that once mortgage infrastructure collapses, it takes decades and millions in subsidies to rebuild. This is a major American city where cash sales outnumber mortgages 20 years after a crisis. Could your city become the next mortgage desert? Number 22. Flint, Michigan. The water crisis made headlines. The mortgage crisis came quietly afterward. Environmental disaster meets lending withdrawal. Flint is part of the Rust Belt affordable housing stronghold where homes cost half the national median. But affordable doesn't mean mortgageable. Population loss is accelerating lending risk. Infrastructure crisis is compounding property devaluation. And here's what most people don't realize. Banks factor environmental contamination into long-term risk models. It's not just about whether the water is clean today. It's about whether buyers will want to live there in 10 years, 20 years, 30 years. When your city's name becomes synonymous with risk, that reputation shows up in underwriting algorithms. Banks don't just evaluate economics. They evaluate reputation and insurability. Picture underwriters literally adding environmental liability as a line item in their risk assessments. How much does a city's crisis reputation affect your mortgage application? Number 21. Cape Coral, Florida. Home prices down 7.8% year over year, with inventory at the highest level in over a decade. A Florida Gulf Coast city facing correction territory. Inventory surged to 14,580 homes in 2025, up from 5,586 in 2023. Home values have been declining 6.5%, 7.1%, 7.8% in consecutive months. Insurance costs are skyrocketing across Florida. Hurricane and flood vulnerability is increasing with every storm season. Migration that fueled the boom is slowing dramatically. This is the market experiencing back-to-back declines not seen since 2008. Cape Coral represents the collision of climate risk, insurance crisis, and overbuilding all happening at once. Sellers are cutting prices month after month while inventory piles up. And the people who bought in 2022 or 2023 are already watching their equity disappear. This isn't theory. This is families making decisions they'll be living with for decades in a market that changed faster than anyone predicted. Is this Florida's warning to other coastal markets? Number 20. Myrtle Beach, South Carolina. At risk for a 20% price correction, and migration is already slowing. A tourism-dependent market where decelerating demand is weakening fundamentals. Heavy tourism dependence creates economic volatility that banks price into every mortgage. Coastal location brings insurance pressures that compound the risk. The seasonal market complicates year-round lending because banks need to see consistent employment and income, where vacation home dreams meet mortgage reality checks. Here's what banks know that buyers often don't. Tourism-dependent markets are particularly vulnerable to economic shocks. One recession, one bad hurricane season, one shift in vacation trends, and the entire local economy wobbles. Banks view this as concentration risk. A city where the off-season now lasts longer than the tourist season is a city where mortgage defaults spike when times get tough. Would you bet on a mortgage in a market this dependent on vacation spending? Number 19. Lakeland, Florida. Rapid listings growth combined with insurance burden. Central Florida city caught between growth and climate vulnerability. Flagged for 20% correction risk. Rapid growth in unsold inventory while insurance costs rise across Florida. Lakeland is positioned between major metros but facing independent correction. Supply buildup is outpacing demand. When growth city turns into too much too fast, banks start asking harder questions. They distinguish between sustainable growth and speculative overbuilding. Picture developers completing projects as buyers vanish. The construction that looked smart in 2021 when everyone was moving to Florida looks like oversupply in 2026 when migration stalls. Banks have seen this movie before. They know how it ends. So they tighten standards before the correction fully materializes. which means the tightening itself accelerates the correction. It becomes a self-fulfilling prophecy. How do you tell the difference between growth and a bubble? Number 18. Sarasota, Florida. Supply risks compounded by the nation's insurance pressure epicenter. Affluent Gulf Coast market facing systemic Florida challenges, at risk for 20% decline. The insurance crisis is hitting hardest in Gulf Coast regions, with non-renewal rates among the highest in the state. Even though this is an affluent market, that actually means larger mortgage exposure for banks. Climate projections show increasing hurricane risk year after year, where million-dollar homes face $100,000 insurance problems. And here's the paradox: wealth doesn't protect you from a collapsing insurance market. In fact, wealthy markets might be more vulnerable because the absolute dollar amounts at risk are higher. Picture luxury homeowners unable to secure coverage at any price. When that happens, the mortgage becomes impossible regardless of income or credit score. No insurance equals no mortgage. Does wealth protect you from a collapsing insurance market? Number 17. Orlando, Florida. The theme park capital where housing fundamentals are disconnecting from tourism success. Major metro facing correction despite continued visitor growth. Identified for potential 20% price decline. Housing supply is surging while affordability weakens. Insurance burden is affecting the entire state. The tourist economy doesn't translate to housing stability the way people assume. Investor presence is creating volatility. When Disney magic doesn't extend to the mortgage market, you realize that employment growth and housing sustainability are two different things. Banks separate them. Orlando can add jobs while home prices fall because the jobs don't pay enough to justify the prices, and the insurance costs keep climbing regardless of employment trends. Picture a city adding jobs while home prices fall. That's not supposed to happen, but it is. Can a booming tourism economy hide a housing correction? Number 16. Tampa, Florida. The sharpest affordability pressure combined with steep price appreciation that's now reversing. Major Florida metro at risk for 20% correction. Tampa recorded the steepest existing home price appreciation in recent years before the reversal began. It now carries the highest insurance burden nationally among major metros. Gulf Coast hurricane exposure means climate risk is priced into every decision. Prices overshot income fundamentals so dramatically that correction became inevitable, where last year's hottest market becomes this year's correction story. Banks know that markets that rise fastest often fall hardest. The appreciation wasn't sustainable. It was driven by migration and speculation, not by wage growth and economic fundamentals. Now that migration is slowing and speculation is reversing, gravity takes over. Picture buyers from 2023 already underwater on mortgages. Would you have bought at the peak? Number 15. Miami, Florida. Highest insurance burden in the nation and lowest mortgage reliance among major metros. Luxury market where cash buyers dominate and banks tread carefully. At risk for 20% decline. Miami posts the highest insurance costs nationally. Mortgage reliance is below 45%, meaning most buyers pay cash. There's dual strain of insurance and affordability hitting simultaneously. Sea level rise projections are affecting long-term valuations. Heavy investor and international cash presence means the market dynamics are completely different from traditional U.S. housing markets. The city where not needing a mortgage is becoming a requirement, not a luxury. When banks see cash buyers outnumbering mortgage buyers, they know risk is being priced in. Wealthy buyers paying cash are telling you something. They don't want 30-year exposure to this market. Lenders are listening. Is Miami's cash market a strength or a warning sign? Number 14. Jacksonville, Florida. Home prices down 3.1% annually, the largest decline among major metros nationwide. Northeast Florida City leading the nation in price drops. Heavy investor presence is creating volatility. Insurance costs are climbing. At risk for 20% correction. The rapid growth phase that defined Jacksonville's pandemic boom is ending abruptly. When being Florida's most affordable big city becomes a red flag instead of a selling point, you know the narrative has shifted. Banks view Jacksonville as the first major Florida domino. And here's why that matters. If Jacksonville falls first, it means the correction is working its way through Florida from most vulnerable to least vulnerable. Being early to decline means more room to fall before equilibrium returns. Picture a market where being first means being worst. Is Jacksonville predicting Florida's future? Number 13. New Orleans, Louisiana. Projected to lose 7.2% of home value this year. Cultural icon facing economic and climate reality. Louisiana has the nation's highest mortgage delinquency rate at 5.8%. Rising insurance premiums from hurricane exposure are compounding an already difficult situation. The land is literally sinking while flood risk increases. Population loss has been accelerating in the years since Katrina, and it never really stopped. Where history and culture can't overcome actuarial tables, banks price in not just current risk, but accelerating future risk. They see a city slowly sinking while insurance companies flee. And the mortgage delinquency rate tells them borrowers are already struggling. When you combine that with climate projections showing intensifying storms, the 30-year mortgage timeline becomes almost absurd. You're asking a bank to bet on a city for 3 decades when the next decade looks increasingly uncertain. Can a city survive when both people and insurers are leaving? Number 12. Phoenix, Arizona, slowing migration alongside rising prices and weakening affordability. Desert Metro, where the growth story is ending. At risk for 20% correction. Migration is slowing while inventory builds. Water scarcity concerns are affecting long-term valuations in ways that don't show up in today's prices but absolutely show up in bank risk models. Prices are still rising despite weakening fundamentals, which is exactly the disconnect banks watch for. Extreme heat trends are impacting habitability projections. When the retirement destination becomes the "should I really move here" question, demand softens fast. Banks are incorporating climate habitability into 30-year mortgage risk models. Picture underwriters adding water availability 2050 to their spreadsheets. That's not science fiction, that's happening right now. Would you take a 30-year mortgage in a city with a 30-year water question? Number 11. Boise, Idaho, rapid community expansion eroding affordability. Pandemic boomtown facing post-boom reality. At risk for 20% correction. New home affordability is weakening while community expansion outpaces infrastructure. The migration surge that defined 2020 and 2021 is reversing. Prices are disconnected from local wages in ways that can't sustain. Where I can work remotely became I can't afford to stay. Banks learned from 2008 that rapid growth markets correct fastest. Boise represents every pandemic boomtown that built for growth that stopped growing. Picture a city built for a future that didn't arrive. The infrastructure, the subdivisions, the commercial development all planned for continued growth. But growth is a story, not a law of physics. When the story changes, the fundamentals reassert themselves. How many pandemic boomtowns will become bust stories? Number 10. Denver, Colorado listings growth accelerating both year over year and long term. Mountain Metro, where inventory is piling up. At risk for 20% correction. Active listings have been surging since 2019 with no sign of slowing. High mortgage reliance at 69% of households means rate sensitivity is extreme. Prices are still elevated despite softening demand. Competition from cheaper mountain states is pulling buyers away. When the lifestyle premium stops justifying the price premium, sellers get stuck. Denver represents high-end markets where buyers simply stopped showing up. Picture sellers waiting months for offers that never come, lowering the price once, then again, and still nothing. Because when rates are high and alternatives exist, the buyers who do have money get extremely choosy. Denver is learning that desirable isn't enough when the price doesn't make sense. What happens when desirable isn't enough? Number 9. Austin, Texas. Overheated market with inventory surge since 2019. Tech hub facing the end of pandemic-era growth. At risk for 20% correction. Massive listings build up while Texas overall sees 3.8% mortgage delinquency rate. Remote work reversals are reducing migration. New construction is still completing while demand falls, creating classic oversupply. Where Silicon Hills meets too many hills of houses. Banks know tech-driven markets are as volatile down as they were up. The appreciation wasn't based on fundamentals. It was based on a moment in time when everyone thought remote work meant they could live anywhere. Now companies are calling people back to offices, and anywhere looks less appealing than it did in 2021. Austin built for 2021's demand in 2025's market. That's the definition of a mismatch. Is Austin's correction a preview for other tech cities? Number 8. Dallas, Texas. Among the largest annual price decreases at negative 2.2%. Major Texas metro experiencing significant correction. Third largest annual decrease among major metros nationwide. Texas mortgage delinquency sits at 3.8%. Massive new construction pipeline is hitting the market right as demand softens. Corporate relocations that drove recent growth are slowing. Oversupply in suburban markets is creating price pressure. When the growth capital of Texas hits pause, people notice. Even markets that everyone was moving to face supply-demand imbalances when they build too much too fast. Picture subdivisions finishing construction as price cuts begin. The homes are beautiful, the marketing is polished, but the buyers aren't there in the numbers needed to absorb the supply. So prices adjust, and mortgages get harder to secure. Can Texas metros absorb all the growth they plan for? Number 7. Oakland, California. Home prices down 2.7% annually. Bay Area city facing exodus and declining values. Second largest annual decrease among major metros. Cost of living disconnect from employment opportunities is driving departures. Crime concerns are affecting desirability. The San Francisco spillover effect that made Oakland the alternative is reversing as remote work enables people to leave entirely. Where being across the bay from San Francisco isn't close enough anymore. Banks watch when even cheaper alternative markets start declining because it signals that the entire region's value proposition is breaking down. Picture a city losing both residents and home value simultaneously. That's a market where mortgages become much harder to justify. The risk isn't just that prices might fall. It's that the entire reason for the city's housing demand might be disappearing. What happens to affordability havens when people can afford to leave? Number 6. San Francisco, California. Projected to lose 6.1% of home value despite being a global tech capital. The Bay Area icon where tech wealth can't stop the decline. Remote work is permanently reducing demand. The commercial real estate crisis is bleeding into residential as downtown empties out. San Francisco has the highest costs in the nation, which creates vulnerability when the value proposition weakens. Tech industry's shift to distributed work means the city is no longer the only option for high earners. When not even Silicon Valley can defy gravity, it tells you something fundamental has shifted. Banks recognize that even the wealthiest markets face correction when fundamentals change. Picture empty offices surrounding empty condos. The city that defined tech wealth is learning that wealth doesn't create demand when the reason to live there disappears. If San Francisco can decline, what does that mean for everywhere else? Number 5. West Virginia, statewide. The state with the third highest mortgage delinquency rate and lowest mortgage reliance in the nation. Entire state representing rural mortgage crisis. Delinquency sits at 4.5%, while outright ownership is at 55.1%, the lowest mortgage reliance nationally. The coal industry collapse is affecting multiple communities with no replacement economy in sight. Population loss is accelerating. Median incomes are among the nation's lowest. Mortgage deserts exist throughout rural areas where banks simply won't lend because home values are too low and default risk is too high. West Virginia represents what happens when an entire regional economy built on one industry faces permanent decline. Banks can't profitably lend when home values are too low and default risk is too high, creating self-reinforcing abandonment. This is the future of any single industry region facing transition, where owning your home outright isn't a choice, it's because no bank will lend. Statewide lending withdrawal shows how regional economic collapse scales beyond individual towns into entire states that become systematically difficult to mortgage. Can a state recover when its banking infrastructure disappears? Number 4. Mississippi statewide, second highest mortgage delinquency rate in America at 5.7%. Systemic economic challenges creating statewide lending caution. Outright home ownership sits at 51.6%, reflecting low mortgage reliance. Persistent poverty affects lending risk across the state. Multiple towns within Mississippi show double-digit projected declines. Limited economic diversification means vulnerability to any sector downturn. Climate vulnerability is increasing insurance costs across the state. Mississippi has faced persistent economic challenges for decades, but the combination of climate risk and insurance withdrawal is creating a new crisis. When delinquency rates approach 6%, banks tighten standards dramatically, creating barriers even for qualified buyers. Climate-vulnerable states with weak economies face compounding risk that banks are pricing into every decision. Mississippi shows what happens when multiple risk factors converge at the state level. Banks are drawing red lines not around neighborhoods but around entire states. The question isn't whether you qualify, it's whether the state qualifies. Is Mississippi becoming systematically unmortgageable? Number 3. Louisiana statewide. The nation's highest mortgage delinquency rate at 5.8%, and insurance companies are fleeing. The perfect storm of economic weakness, climate exposure, and insurance collapse. Highest mortgage delinquency nationally at 5.8%, with 1.7% of loans over 90 days past due. Insurance non-renewal crisis is spreading across the state. Hurricane exposure is intensifying with climate change. Major cities like New Orleans face 7.2% price declines. Coastal land loss is accelerating. And here's the connection most people miss. A $500 insurance increase drives a 20% rise in missed mortgage payments. Louisiana has always faced hurricane risk, but climate change is making storms more frequent and intense while simultaneously making the state less insurable. Banks evaluate 30-year risk, and Louisiana's 30-year outlook includes accelerating coastal loss, insurance market collapse, and property devaluation. This represents the first U.S. state where climate risk, insurance withdrawal, and banking retreat are creating a synchronized crisis that may be irreversible, where missing one mortgage payment is 20% more likely just because your insurance went up. This is what the Federal Reserve meant when it predicted mortgages won't be available in some regions within 10 years. Is Louisiana showing us the future of all coastal states? Number 2. Florida inland counties. The overlooked epicenter of Florida's insurance crisis, and the poorest residents are hit hardest. While coastal Florida makes headlines, inland communities face a bleaker crisis. The highest non-renewal rates aren't in Miami-Dade or coastal counties. They're inland around Lake Okeechobee. Poor rural communities are navigating an even bleaker insurance market than wealthy coastal areas. The state saw a 3% non-renewal rate in 2022 to 2023, highest in the nation, but inland areas are far worse. Citizens Property Insurance, the state backstop, may need to issue bonds and surcharge all Florida homeowners to cover losses. About a third of flood claims come from outside high-risk zones, meaning inland doesn't equal safe. Everyone focused on South Florida luxury real estate, missing that already disadvantaged communities face uninsurable status first. Insurance companies look at Florida, seeing a combination of sea level rise and worsened storm activity and warming oceans on three sides, and realize risk is unpredictable. When insurance collapses, mortgages follow. An entire state's housing market becomes systematically unstable. The federal government stands to lose hundreds of millions in mortgage-related costs from flooding, where being inland doesn't protect you because the entire state's insurance market is collapsing together. Banks don't differentiate between coastal and inland Florida anymore. They see systemic state-level risk. Picture homeowners in the center of the state unable to get coverage because hurricanes hit the edges. The entire state becomes uninsurable together. If inland isn't safe, where in Florida is? Number 1. Nationwide flood zones outside FEMA maps. Banks use flood risk data that most homebuyers have never seen, and it shows 500,000 high-risk homes outside official flood zones. The invisible risk reshaping American mortgage lending. 500,000 homes outside FEMA flood zones face high flood risk according to private models that banks actually use. Only 460,000 flood insurance policies exist among 10 million homes in Hurricane Helene's path. 1/3 of flood insurance claims come from outside the highest risk zones, proving official maps don't capture real risk. Lenders are aware of flood risk outside FEMA zones and are adjusting lending accordingly. The Federal Reserve warns the 30-year mortgage model wasn't designed for climate chaos. A FEMA spokesperson admitted no risk zones don't exist. For decades, FEMA flood maps determined everything: insurance requirements, lending standards, property values. But those maps are outdated, and banks know it. Banks hold mortgages for 30 years. They're using private climate models showing risk that won't appear on official maps for years, and they're restricting lending accordingly. This represents a fundamental break between official government risk assessment and private financial risk assessment. Banks are quietly redlining entire regions based on climate data that hasn't been publicly acknowledged yet. This is the #1 issue because it's nationwide, it's invisible to most buyers, and it's already changing lending decisions in ways that won't show up in official data for years. Imagine buying a home, being told you're not in a flood zone, then watching your mortgage application get denied because the bank's model says otherwise. Picture two maps of America, the one FEMA shows you and the one your bank is actually using. Those maps are very different, and your bank is using the one you've never seen. How many Americans are buying homes in zones their banks already consider uninsurable? If you're still watching, you're already noticing patterns most people miss. Florida dominates this list, but it's not the only story. The locations we just covered reveal something banks are even more concerned about: a fundamental mismatch between official risk assessment and private financial reality. The gap between those two things is where mortgage lending is quietly disappearing. Whether it's climate models that haven't been made public, delinquency rates hitting 6%, or entire states where insurance companies are withdrawing, banks aren't reacting to this year's market. They're positioning for the next 30 years of risk. And in 25 different ways, across Rust Belt cities, coastal zones, and boom towns that built too fast, they're telling us the same thing. The 30-year mortgage model that built American homeownership wasn't designed for what's coming next. If this helped you see the patterns before they become headlines, subscribe. Every week we break down the economic shifts most people won't understand until they're already paying the price. Because by the time everyone knows banks are restricting lending in your area, it's already too late to get a mortgage. We track the data, connect the patterns, and show you what's happening before it shows up on the evening news. That's the value of this channel. Hit subscribe, and we'll see you in the next one. Use a male voice with a southern accent for the narrator settings. Add all caps subtitles with a spoken word. Highlight. Use YouTube audio library. Only use appropriate media. Use a male voice with a southern accent for the narrator.